The Federal Reserve instilled confidence in the banking system by setting required reserve ratios that forced banks to keep enough money in reserve to weather high levels of withdrawals. They were also able to intervene when a panic threatened the entire system by lending directly to banks, preventing the panic from spreading when a bank fails due to a run. But the Fed has another power that it can use to meet its mandate of maximum employment, price stability, and moderate long-term interest rates. The Fed has the power to print money and use it to achieve those goals. When the Federal Open Market Committee wants, they can simply create money out of thin air, and they do the same thing we would do if we had this superpower. They go shopping. But the FOMC is full of very serious and boring people, and they only go shopping for one thing: government bonds. Large organizations like big corporations or the US government usually don't turn to banks when they need to borrow money. Instead, they leverage their reputations and sell bonds directly to investors. Every day, the U.S. Treasury auctions these bonds, like the Treasury bill shown here, in order to raise money to cover a budget deficit. A bond is just an agreement to pay a certain amount of money on a certain date. The bond shown here was issued on October 9, 1969. The buyer paid something like $96,575 for this bond at that time. And 6 months later, the U.S. government paid them $100,000. But if that buyer wanted to, they could have sold it a month early to someone else for around $99,429, essentially foregoing the interest they would be earning for that last month. In fact, there's a massive market for reselling government bonds before the date they mature. And a very frequent participant in those markets are banks. Because the market for reselling government bonds is so big, they are usually the only assets the Federal Reserve will think about buying through open market operations. Open market operations are when the Fed buys or sells securities or financial assets like government bonds on the open market. Here's the idea behind these open market operations. Banks use deposits to make loans, and a good chunk of those loans they make take the form of buying government bonds, essentially lending money to the government. But from time to time, something will happen that kicks off a financial panic and leads many people to withdraw their money from banks. Without enough cash in reserves to meet those demands, a bank could fail, even though they have all of the financial assets like government bonds. The bank needs to liquidate those assets by selling them for cash. In a financial panic, there aren't a lot of buyers for these bonds, so the Fed can step in and create a bunch of money and go shopping for them, buying them off the banks and infusing the banks with the cash they need to cover the demands of their depositors. Eventually, the panic subsides, and the money people withdrew in fear makes its way back into the banks. But with so much money in circulation, there's bound to be inflation. But the Fed is sitting on all these valuable financial assets. Now they can sell the bonds back to the banks in exchange for the cash, and then just delete the cash, avoiding the financial panic and the inflation altogether. With its three tools, the Federal Reserve has the power to manage financial markets and promote economic stability. When a panic ensues and results in a rapid and sharp decrease in the supply of loanable funds, it can be devastating for an economy. Businesses lose access to critical loans. Bank runs lead to bank failures, which means depositors at those banks lose everything they have, and production stalls. And while these panics sometimes happen in just days, their negative effects on the economy can last for years. To prevent those negative effects, the Fed has the power to bring an end to the panic as quickly as it starts, to increase the supply of loanable funds, the Fed could lower the required reserve ratio, letting those reserves loose so that banks have access to the liquidity they need in a crisis. They can also lower their own discount rate, which is the interest rate the Fed charges when it makes loans directly to banks. As the lender of last resort, the Fed can help otherwise healthy banks stay afloat during the crisis by giving them direct access to the credit they need. And then there are open market operations, where the Fed can create new money and use it to purchase bonds in the open market, flooding banks with cash in exchange for these financial assets. Any and all of those options can be used to increase the supply of loanable funds, bringing down interest rates and helping to restore the economy after a panic.